Stocks surge, sentiment softens, but the bond market whispers worry. Relief rallies rise fast, but fragile foundations can fail even faster. Markets are moving on hope, not certainty. Headlines are heating up with talk of a possible United States and Iran agreement, and investors are reacting quickly. Stocks are climbing, oil is cooling, and for a moment, it feels like tension is turning into temporary calm. But beneath that surface, something quieter, something more cautious is still unfolding. Because while equities are celebrating, bonds are hesitating. And that hesitation matters. Right now, what we are seeing is a classic headline-driven rally. The mere possibility of a diplomatic breakthrough between the United States and Iran is enough to shift expectations across global markets. Oil prices begin to drift lower as traders anticipate fewer supply disruptions. Lower oil feeds directly into lower inflation expectations, at least in the short term. And when inflation expectations fall, equity markets tend to breathe a sigh of relief. But that is only half the picture. Bond markets, which often act as the deeper, more disciplined signal of economic reality, are not fully confirming this optimism. They are not collapsing into a full risk-on mode. They are not pricing in a clean, stable future. Instead, they are holding back, suggesting that something about this rally is incomplete. My name is May, and this is What Changes, the channel where we track the ships in the global financial system before the headlines catch up. So let's break this down carefully, because this is where the story becomes more complex and more important. At the center of this rally is oil, and I want to spend a little time here, because once you understand why oil sits at the center of this story, everything else, the rally, the divergence, the caution in bonds, starts to make sense. Oil is not just another commodity. It is the bloodstream of the global economy. Almost nothing moves without it. The trucks that carry goods to stores, the ships that carry containers across oceans, the factories that manufacture everything from plastics to steel, all of it runs on energy, much of it still derived from oil. When oil prices rise, transportation costs increase immediately, and that cost gets passed along the supply chain. Manufacturing becomes more expensive, and because oil touches nearly every stage of production and distribution, the inflationary pressure it creates spreads. It shows up in food prices because farm equipment runs on diesel. It shows up in airline tickets, in heating bills, in the delivery fee on your online order. When oil falls, the opposite happens across that same wide network. Costs ease, margins improve, and central banks, constantly fighting the battle between supporting growth and controlling inflation, gain breathing room. That is why even the hint of a United States and Iran agreement is so powerful. Iran is a major oil producer. Any easing of tension could increase available supply, or at least reduce the risk premium traders build into prices simply because of uncertainty. Markets do not need certainty to react. They only need a shift in probability. And that perceived increase in stability, even incomplete, even unconfirmed, is enough to push oil lower in the short term. Lower oil then feeds directly into market psychology. Investors begin to believe inflation may cool faster than expected. They imagine a future where the central bank does not need to stay as restrictive. And suddenly, equities find a reason to rally. Not because the underlying data has fundamentally changed, but because the story investors are telling themselves has changed. But now, here is where this gets serious. This entire chain reaction is built on expectation, not confirmation. There is no finalized deal. There is no guaranteed outcome. The geopolitical situation remains fluid, fragile, and fast-moving. Negotiations can stall. A single incident can undo weeks of perceived progress in hours. And markets, as we have seen time and time again, can reverse just as quickly as they rise. And this is the part that most people are missing. Bond markets are not fully buying into this narrative. If this were a true shift toward lasting stability, We would expect to see stronger alignment across asset classes. We would expect bond yields to reflect a clearer path toward lower inflation and controlled economic conditions. But instead, bond markets are sending a more cautious signal. They are saying, in effect, that the risks are still there. Why does this divergence matter so much? Because equities often react to optimism while bonds react to reality. Stocks can be driven by sentiment, momentum, and short-term narratives. A stock's price reflects the market's collective guess about future earnings, and when sentiment improves, prices can move higher simply because investors are willing to pay more for the same future cash flows. Stocks are, in a real sense, a vote on hope. Bonds are different. A bond is a contractual promise, a fixed return over time, and that return only makes sense in the context of where inflation is expected to go and what alternative returns are available elsewhere. Bond investors are pricing probabilities, not feelings. They are asking concrete questions. What is the likely path of inflation? What is the likely path of policy? What is the risk that more debt issuance puts upward pressure on yields? Bonds are a vote on probability. When these two markets move together, the signal is stronger. But when they diverge, when stocks are celebrating and bonds are holding back, it creates tension. It tells you the optimism driving prices higher in one part of the market is not yet supported by the more disciplined analysis happening in the other. And right now, that tension is building. Now let me connect the dots to the broader macro picture, because this divergence does not exist in a vacuum. Even if oil prices fall in the short term, the global economy is still dealing with persistent inflation pressures that have nothing to do with this particular conflict. Supply chains have not fully normalized. Labor markets remain tight in key regions. Government debt levels continue to climb, with the United States carrying tens of trillions of dollars in obligations. And central banks are still navigating one of the most complex policy environments in decades. The Federal Reserve in particular is walking a very narrow path. On one side, the need to control inflation. On the other, the risk of over-tightening and triggering a deeper slowdown than necessary. This leaves very little room for error. Lower oil prices may offer temporary relief along that narrow path, giving the central bank a bit more flexibility in how it communicates policy. But they do not solve the structural issues driving inflation more broadly. They do not resolve the debt dynamics. They do not resolve the labor market tightness. They address one visible symptom while leaving the underlying condition largely intact. And bond markets understand this. They are not just looking at oil, they are looking at debt. They are looking at fiscal deficits and how those deficits will be financed year after year. They are looking at long-term inflation expectations, not just last month's print, but where prices are likely to be 3, 5, 10 years out. And they are asking a simple but critical question. Is this rally sustainable, built on a genuine improvement in underlying conditions, or is it just another short-lived surge driven by hopeful headlines that have not yet been tested against reality? So here is where we stand. Stocks are rising because the market sees a potential path toward lower oil prices and reduced tension. That creates a short-term bullish narrative. But bonds are holding back, signaling that deeper risks remain unresolved. And oil, the key link between geopolitics and inflation, is still highly sensitive to any shift in the situation. Now imagine what happens if this deal does not materialize. Oil could spike again, and quickly, because the uncertainty that had been temporarily priced out would need to be priced back in, often with added urgency since failed talks tend to read worse than no talks at all. Inflation expectations would rise right back toward where they were. Central banks would be forced to maintain or even increase their restrictive stance. And the same equities rallying today, pricing in a brighter future on an unconfirmed story, could reverse course just as fast. This is not a stable foundation. This is a fragile framework. And in fragile environments like this one, the assets that behave differently from the crowd become even more important to understand. This is where gold and silver come into the picture. During geopolitical relief rallies like the one we are watching unfold right now, precious metals do not always move in the same direction as stocks. In fact, they can sometimes pull back as immediate fear fades and risk appetite returns. But that short-term reaction can be misleading, because gold and silver are not just reacting to headlines. They are responding to the deeper structure of the financial system, the same structure that bond markets are watching so closely. Gold, in particular, is highly sensitive to real interest rates, currency stability, and systemic risk. Gold pays no yield, so its appeal grows precisely when the after-inflation return available from cash or bonds shrinks because the opportunity cost of holding it falls. If bond markets remain cautious, if inflation remains persistent, even as headline oil prices ease, and if central banks remain trapped between conflicting goals, then the underlying case for gold does not disappear just because stocks are having a good week. It strengthens. Silver adds another layer to this story. It carries both monetary and industrial demand, which makes it more volatile than gold, but also more responsive to shifts in both growth and inflation expectations simultaneously, which is exactly the environment we are in right now. So even as equities celebrate a possible breakthrough, precious metals are quietly watching the bigger picture, and the bigger picture is still uncertain. This is not a world where risks have been resolved. This is a world where risks are being temporarily repriced. And that distinction matters, because when markets move on hope rather than hard outcomes, volatility does not disappear. It simply pauses. Now think about the pattern we have seen over the past few years, because this is not the first time markets have found themselves in this exact position. Time and time again, markets have rallied on positive headlines only to reverse when reality fails to match expectations. Whether it was inflation cooling faster than expected and then proving stickier in subsequent months, or central banks pivoting sooner than expected and having to walk it back, or geopolitical tensions easing more than expected only to flare back up. The market has repeatedly priced in best-case scenarios well ahead of confirmation. And repeatedly, those scenarios have faced challenges. So the question now is whether this moment is different or just another example of the same cycle. Are we seeing the beginning of a genuine shift toward stability, or are we witnessing another temporary rally built on uncertain ground? Because if bond markets are right, this is not the end of volatility. It is simply the next phase. And if that is the case, positioning becomes critical. Not chasing equities higher because the headline of the week feels good, but understanding the balance between risk and resilience. Not just reacting to headlines, but analyzing the signals beneath them, especially when those signals disagree with each other. That brings us back to gold and silver. In a world where inflation remains uncertain, where debt levels are high, where central banks are constrained, and where geopolitical tensions can shift overnight, precious metals continue to serve a unique role. They are not dependent on corporate earnings. They are not tied to a single country's policy decisions. They exist outside the traditional financial system, acting as a form of insurance against instability. That does not mean they move in a straight line, but over time, they reflect the deeper currents that drive the global economy. And right now, those currents are anything but calm. So as stocks rally and headlines turn hopeful, it is worth asking a deeper question. What is the bond market telling us that the equity market is ignoring? And more importantly, what happens if that message turns out to be right? I want to hear your perspective on this. Do you think this rally has real staying power, or is it another short-term move driven by fragile optimism? Let me know in the comments below. And if you want to go deeper into these shifts, I share more detailed breakdowns through the What Changes email list. The link is right below this video. It is where I connect the dots between geopolitics, markets, and monetary policy in a way that goes beyond the headlines. And if you find this kind of analysis valuable, you can support the channel by buying me a coffee. Every contribution helps me keep this research going.